This is the continuation of our Simple Tax Solutions tax software and tax training course. We hope that in the prior lessons that everything has turned out beneficial for you, that you have been learning a lot of things, and as we go forward, we plan to increase this knowledge. If you have any questions that are unanswered from any prior course, please jot them down, and we will get those questions answered by the end of this course. And if you have any questions during the course, please remember to write those down as well. We hope that everything has been very simple for you guys, that you know, this knowledge is just filling your minds and making you more excited to get into this taxation and tax preparation industry. But also, don't let your knowledge stop here. You know, the key to being a tax professional instead of just a tax preparer is to just, you know, expand your knowledge and continue getting educated in this industry. You know, you have tools such as Google. You have a team here that has tax knowledge and tax experience, excellent and expert tax knowledge and tax experience. As well as you have the IRS publications. Publication 17, you can go to irs.gov, click on Publication 17. It has a lot of information that is very important to the industry that we're in. So without further ado, we're going to go ahead and start with our next lesson. In your prior lessons and courses, we talked about the main info sheet, the client organizer. We had taken a look at that, explained it in depth. We had taken a look at Form 2441 in the case that someone has, you know, dependent care or has to write off for child care expenses. We looked at Form W-2. We looked at Form 1099. We also talked about Schedule A, B, and C. But today we're going to take more of an in-depth look at Schedule A and Schedule C. We hope that these things are, you know, very understandable for you, and that you gain a lot of knowledge from it. So we're going to go ahead and begin. And as we left off, we were preparing a return for the sample client, John Smith. Just to give you guys a look at the main info sheet again. And immediately following training, you guys will, you know, either receive the software for software training, or you can come in and do software training. Just get some sample scenarios in, and make sure that you're understanding of everything before you're asked to go out in the field and actually perform tax preparation. Also, you guys remember, go ahead and register on irs.gov. Sign up for your PTIN number. Your PTIN number. That's the number that identifies you during tax preparation, and you must have this number to prepare taxes. The amount for this number is $64.25 if this is your first year signing up. If you're just renewing your PTIN number and you've had one in prior years, it's $63.25. All right. So now we're going to go ahead and we're going to look at the Schedule C form. Now, we talked about the Schedule C form, which was also attached to a 1099 in our prior lesson, in which the 1099 carries over to the self-employment form because, you know, he was doing some subcontractor work for a specific company, and, you know, when you pull up the 1099, a Schedule C also pops up. Now, let's just say that Mr. Smith also, as we mentioned before, he's a painter. So he paints for a company, but also he does painting on the side, and he wants to report his Schedule C income. And I'm going to show you how this operates, and I'm going to show you, you know, how it boosts his AGI as well as his refund with these other documents on his return, and then we're going to clear all other documents off this return, and then we're going to talk about self-employment in general if he was only self-employed, so you'll know the two variations. And then we're going to go into Schedule A, so on and so on. All right. Now, to add this form, just like with adding any form, you'll go to the Add Form tab, click on Add Form. We'll go over and we'll type in schedule, but we won't type in the full word schedule. It'll be SCH, hit the space bar and the letter C, or whatever schedule we're trying to pull up. And you guys also see it right here in the Forms menu. And if you could, I would like you guys to jot down, type in SCH space C or A or B or whatever form you're pulling up. And we're going to go ahead and select Sole Proprietorship Profit or Loss Form, page 1. Double click on it. And since we already have a prior Schedule C open from when we were reporting his job income, we're going to select New Schedule C. And the same thing is in the case that if we were pulling up a new W-2 for this individual. You know, W-2 would pop up. We would double click on it. And you would also see the wage and tax statement that we put in from his Kroger job. And then it'll say New W-2. Just in case he worked at Mapco or Walmart or somewhere else, you know, we could also click on this W-2. And there will be a blank W-2 for us to fill out just like the other W-2. And you'll also see that the one from Kroger is also still on the return. If you want to get to any form, go to your Forms tree, look for it, and click on it. This is the new one. This is the old one. And you're not limited to how many W-2s or 1099s you can put on a tax return or Schedule Cs. How many ever that person has, that's how many they have. All right, so since I was just showing you guys that example, I'm going to remove this form. And we're going to type in SCH space C. We're going to go ahead and open up a new Schedule C. All right, the Schedule C is one of the most popular forms that we've dealt with in every year. One reason is because every single person in the Mid-South, well, a great majority of everyone, you know, it doesn't matter if you have a corporate job, you're working in corporate America, if you work, you know, at a warehouse, because, you know, we're the distribution hub, you know, of the country. So, you know, there's a lot of warehouse workers here. But, you know, no matter what job they work at or what trade they are, there's always people doing something on the side. You know, people are going to cut hair on the side. A lot of ladies or young ladies or women do hair out of their home. You know, they do the sew-ins, they do the braids. You know, you get a lot of guys do the detailing of cars. You got a lot of rappers here, a lot of entertainment. You know, you got a lot of everybody that's doing everything, you know, outside of their workhouse to make and generate income. The IRS standard rule is if you made over $400 doing any one of these tasks, then you're required to file it. So all we want to do is help these clients file the return that's needed and get the money that's due back to them, or show them what they need to pay. All right, so we're going to start from the top of this Schedule C, as we do with any form. It says U.S. Schedule C, profit or loss from a business, small business return, and this is the tax year. Okay, the business or profession is owned by the taxpayer. Now, in the case someone was married filing jointly and their spouse was on there, you know, if the guy was the primary and the wife was under spouse, and this is a spouse's business, of course you would click spouse. But now we're clicking taxpayer because he's the only taxpayer on the return. All right. And no, I have had this question before. Can a person that's filing their return and they are the client or the taxpayer, that's the term given, you know, by the IRS, the taxpayer, because, and I'm going to show you something, even though you're getting a tax refund back, you're still paying taxes. You're still paying taxes even though you're getting a tax refund back. It's in the taxes, and I'm going to show you guys. Let's see if it's already calculated, but if not, it will be once we key in some figures from this return. Okay. Now, even though this person has not had, we hadn't put in any Schedule C or self-employment income as of yet, there is already a self-employment tax that's being taken out on this person. This individual is already paying $369 worth of self-employment tax. Now, I know you guys are like, okay, well, where did that tax come from? Well, it's just like the taxes on the W-2. When you have a W-2, they take out for Social Security and Medicare tax. This 1099, he got paid $2,613, but there was no federal withholding, and there was no other type of taxes taken out. So it automatically calculates, and the IRS takes taxes from you out of every type of income you make. And if you want to see how much self-employment tax comes out of a self-employment return, write this down, you guys. Go to Schedule SE, Schedule SE, SE. S is in Sam, E is in egg. Schedule SE, and then go to line 12, self-employment tax, and you'll see how much taxes are being taken out. You know, we get clients that come in every season, and they say, well, you know, why does my friend here, who has basically the same amount of income that I have, and we have the same amount of children, how come she got $7,000 or $8,000 and I got $5,000 or $6,000? Well, the difference is, if you worked a job and you had that W-2, they had taken taxes out on you, that person, all year. So they give a portion of that back with the refund. If you hadn't paid in any taxes at all, they're going to take your taxes out with your taxes. So a person that worked a job, you know, they'll get a bigger refund. But a person that's self-employed, they'll get a lesser refund, but they don't have to pay any tax obligation during the year. So we're going to go ahead and start filling this form out. And it says in line A, his principal business or profession, including product or service. This means, what activity did he do? What was the occupation that he did in his business? We're going to select painter. And again, make sure your caps lock is on. We're going to click type tab. I'm going to tab off to business codes. And anytime in TaxWise, you know, if you want to know or find out where something is, again, refer to your TaxWise help at the very bottom in the blue, and it tells you. It says, enter the 6-digit code that identifies the principal business or professional activity. To find the codes in TaxWise help, press F1. So we're going to go ahead and press F1 on the keyboard. TaxWise help pops up, and it says, click here for a list of business codes. Now when we click on this, because it's not time for the computers to be updated and receive its first update for the season, there aren't going to be any business codes. But if there was, there'd be a list of occupations. You know, in general, different types of business, not business names, but different types of occupations such as painter, automotive repair, florist, mechanic, beautician, barber, so on and so on, and it'll have the business code next to it. So for now, we're going to leave this business code blank. But you can also type in, if you ever run into a business code and you cannot find the specific business code that represents that occupation, type in the number 9 6 times, and the IRS will present a code for that occupation. If it's something that, you know, you've never heard of and you can't find it, let's say someone's a horse rider, you know, they're a jockey or something, or it's just something, some type of wild type of thing that they do for money, but you can't find the business code. Well, you would type in the number 9 6 times, and the IRS would assign a business code to that return. Now, you really want to go ahead and really find the business code for that person and put in a business code, because you don't really want it to go to the department where the IRS actually physically put a business code to it, because it can kind of hold up the client's return and things of that nature. If you want a smooth, swift refund for your client, so they put their trust in you, you want them to get their tax money back, so that you have a satisfied customer. So we'll find those business codes, and you can also contact your members of management, and we'll send to your email. We want everyone to create a company email we can communicate with you through, and we can email you a list of all of the prior year's business codes and things of that nature, just in case you get started before they actually release an update, which is usually around the middle of this month. All right. We're going to go to line C, which is business name. And it says, if there's no separate business name, leave it blank. What that means is, if John was a painter and he didn't name his business, then just leave it blank. Some people cut hair. They don't have a barbershop name. They just do it in their kitchen. It's just, you're going over Rico's house. Rico's going to cut your hair. Mark is going to cut your hair. And he doesn't have a business name. You can leave that blank. If he doesn't have an employer identification number, you can leave it blank. The IRS does not penalize a person for not having a business name or an employer identification number. Another misconception that people have about the self-employment filing of a return, they always think that, sometimes people tell them, well, you can't file self-employed if you don't have a business license. Not true. The IRS does not mandate that you have a business license to be deemed a business. That's something that you have to do with the county and state that you're in. You're going to the state building to get a business license, or a city hall. The IRS does not mandate that you have a business license to run a business. They just want to know about all income made. So yeah, you may, run into some problems later on, if you're running a business out of a building and the state wants to see it, or code enforcement comes by. But, to file your taxes, you do not need a business license. It's not required for you to have an EIN or a business name. But we're going to say that John does have a business name, and it's going to be John's Painting. And we'll say that he does have a EIN number. And just to give you guys some knowledge on what an EIN number is, to get your tax knowledge where it should be, an EIN number stands for Employer Identification Number, and every business has one that's an official business or a large business. A home-based business doesn't have to necessarily have one, but once you actually get a storefront and things of that nature, or an office space, you may want to get an employer identification number. What this is, it's a 9-digit number. It's just like your social, except it doesn't have the dash after the second set of digits. But it represents the 9 digits of, and that's how the IRS identifies your business. This is what you'll need to build business credit and things of that nature. And it actually gives you the authorization to hire and pay employees. Of course, you can have some contract labor that you just pay out of pocket, but to actually give them W-9s and W-4s to fill out so they can get 1099s and W-2s, you actually have to have an employee identification number. So we'll say that John has an employee identification number because he's a painter, so he's more than likely licensed and bonded and things of that nature. So we're going to go to line E next. And it asks for a business address. Again, if his business was his home business and that's where he did business out of, you can type in his home address off of the main info sheet. To find that, you'll just go click on your main info sheet. Boom, and there it is. Well, we're going to go back to our self-employment form. And another thing I love about TaxWise, when we typed in his principal business or profession, it put it outside of that Schedule C, so it's easy to find. So even if we were on the 1040 page 2 form and we were looking for that exact self-employment form that we were on, we'll go to the Schedule C page 1 where it says painter. All right, so we're going to say that John, he had an office space for his painting business. We're going to type in that address, and then we're going to type in the zip code. And again, once you type in the zip code, TaxWise automatically knows the city and state. Okay. Now, on this return, it asks for the accounting method. That means basically, how did he get paid? He got paid in all cash. He got paid in all cash. If it was a check as well as cash or checks as well as cash, you can click other and then specify. You can type in cash and checks if need be. But we're just going to assume that he got paid all in cash. He received a deposit, when he got to the job, and, he picked up his final balance once he got done. All right. G. G is very important. It says, did you materially participate in the operation of this business during the year? And it tells you, if you select no, losses may be limited. So basically what that says is, when it says, did you materially participate, did you pay for materials, did you pay for supplies, and other things? All right. So we're going to go ahead and select yes, he materially participated. Because, he purchased things for the use of the business, and he had to have supplies. So if he selects no, he didn't have to purchase supplies and things like that, then IRS is going to want to know, well, where did you get your supplies? What were they supplied to you? The only person that may, file a return and they're self-employed and they didn't have to buy anything would be maybe, I would say maybe a singer. But if they even had studio time, that's something they can write off, So everyone pretty much has to purchase supplies, and when you select no, it kind of raises a flag. All right. So guys, write that down. Materially participate means, did you purchase supplies? If you didn't purchase supplies, then losses may be limited, and it can draw a red flag. All right. So you want to explain it to your client. All right. If you started or acquired this business during the year, click here. You don't have to select there because it's not in red. It doesn't have to be answered. But last year and in prior years, well, the last 2 years, we would actually have to click here. Like if someone just started the business this year, we would check there. But I guess obviously right now we don't have to. But just in case it lights up again later on the season, once we receive an update, you'll know to just go ahead and select it if yes, if this is the first year, or no if it isn't. All right. Did you make any payments in 2013 that will require you to file Form 1099? What this means is, it's not talking about the other 1099 that he has on here. It's talking about for this business. Did he make any payments? Did he pay his self-employment taxes to the IRS? No, he didn't. He just waited to file annually. Most people do. But if they paid some taxes to the IRS during the year, you'll hit yes and then report what they paid. But 90% of all self-employed people just pay annually. So we're going to tab off. And now we're going to scroll on down. We're looking for red lines, red boxes. Now we come to the income portion, where it's asking about income. All right. Line number 1, even though it's not in red, and this is something you'll have to remember, write it down. Line number 1 on the self-employment form of Schedule C is where we report income. The gross income is on line 7, but you'll see if you try to type it in, it's going to say calculated entry, right click to see choices. If you see that, you can't type there. So it really wants you to type in box 1. All right, so gross receipts and sales means how much money did he make? We're going to say he made an extra $5,000 doing painting. We're going to type in a cents as well and just let TaxWise calculate if he did have cents. And something's going to happen again when we click off, because anytime you're adding some income, 2 things are going to happen. AGI is going to go up, refund is going to go up or down. So we're going to tab off. Boom. His refund went down a little. because his refund originally was at $8,248. Now it's at $7,300. And we're going to do two types of self-employed returns. We're going to do one where, the refund went down when you actually put in their self-employment income, and we're going to do one without anything else on here. All right. Now, the first thing we want to let our client John know is that, he could have actually made $5,000. But, we want to make sure that he does write off expenses. So what expenses would John have? So we want to ask John. And, once you've collected all this information, you can print out this actual form here and have the client sign it, just to make sure that they gave you this record and, you don't have any problems with the IRS. Because what people will do, if they don't get their refund, they'll want to point the finger at someone. And the person they're going to point the finger at is you. So you don't want them to be able to point the finger at you. You want them, whatever they bring to you, you want them to sign off on it. So we even have expense sheets already, typed up in there in what we call our simple folder, and they're on the desktop. You can print one of those off and just fill in the blanks for the client. All right. So the next thing that we want to do is ask John. Hey, John. We see that you were a painter, and we need to know exactly what expenses you had and what you paid for, so we can report this for you. So the first expense in the expenses part 2 is advertising. We want to go ahead and click on advertising, and let's just say John said, hey, look, I spent $900 in advertising. He had maybe a couple of radio commercials, maybe put some ad in the newspaper. He may have gotten some business cards done, flyers done, may have gotten some signs for his truck, some signage, to stick outside his office, things of that nature. So we're going to type in advertising. We're going to tab off. Okay, that gave us a little money back for his advertising. Let's say he had car and truck expenses, such as gas, fuel, and things like that. We're going to talk about how to input this in a later lesson, because it's going to take pretty much a little while to show you how to do it. So we're going to skip on down to commissions and fees. If he had any commissions and fees, any type of fees, let's say he had to have some type of fee to become a painter. There's some type of license or something he has to pay for. Or in the case, let's say someone buys into another business and there's a fee or a commission to buy into that business. That's where you will put commissions and fees. All right. John didn't have commissions and fees. We're going to ask him, okay, John, so you did painting and things of that nature. Did you pay anyone to help you? Let's say John says, okay, yes, I paid a cousin of mine to help me out. I paid him $750. You type in that contract labor, and you'll tab off. He'll get a percentage of that back in his refund. All right. Now, does he have to issue a W-2 or 1099 for his cousin that helped him? No. If a person pays someone generally under $3,000, they don't have to issue them 1099. But his cousin could turn around and claim this self-employment income on his return, so he could claim that $750 of income that he did make from John. Would he have to have any type of documents or anything? No, not unless the IRS, wants to see it. They would like to probably maybe see a paper record, which is something written down from John, a receipt or so, saying, hey, look, I paid you this, some type of pay statement, and with both of their signatures. That would be it. All right. So we have that income in. We're going to tab off. Depletion. If he has any type of depletion, what that is pretty much, let's say he has some stuff that can be depleted. He will put that here. And we'll talk about depletion in another lesson. Depreciation. depreciation, if he has any type of depreciation, we can put that in. What depreciation is let's just say that John has a spray rig, a paint spray rig. He has some computers. He has some tools on his truck and things of that nature that he's had since last year. Well, he can depreciate the value of those items, you know. So this comes with a whole nother form, a depreciation form, and we'll go over this in a later lesson. Depreciation and amortization. And that's how a person, if they've had tools and things for over some years, printers, whatever, you know, those items depreciate. You can write off the depreciation of those items. If he paid for any employee benefits programs, all of that will go here. And what that will be is, and you can also resort to tax-wise help if you need answers for some of these questions that you're asking about. Examples are accident, health plans, group term life insurance, dependent care assistance, things of that nature. If he didn't pay for any of that for his employees, any type of insurance or any type of plans like that, then you just want to go ahead and leave that blank and move to the next one. Insurance, other than health insurance for himself. All right. Now, if he had to pay for any type of insurance, let's just say he has rental insurance on the property that he's leasing, that office space we've been talking about. Let's say, you know, he has rental insurance, and, you know, it's only $125 a month. Then we'll write that off. So we'll go to tools to calculate that. Remember, you got a calculator and tools. We'll put in 125 times, he had it all year long, 12 months. That equals $1,500. We'll put that in. All right. Mortgage paid to banks. If he had any type of mortgage, if he had some type of property that he owned, some of our Simple Tax Solution buildings, you know, they're actually owned. You know, if they're not paid for and they have a mortgage on them, you know, you can write off your mortgage right here if you actually have some buildings that you own, but you have a mortgage on them. You know, if they're paid for, you don't have to put that there. But if you have a mortgage on a building, you would actually put that there. All right. Legal and professional services. If he had any type of legal or professional services done for his business, he can write that off. That would be, you know, if he had to hire an attorney, if he had to hire an accountant, you know, someone to keep his books. All those are legal and professional services. Also, his prior year's fees for his tax preparation, you know. Tax preparation, he can write that off. Let's say he got charged last year $4.99 to get his taxes done. He write that off. And their return is still going up. It's giving them back a portion of everything. And that's why, you know, the Schedule C is a great form for people that own businesses, because they can write off all the expenses that they've had. Office expense. If he had, you know, office supplies, any of his small tools, paper products, so on and so on, any type of office supplies, you know, rulers, tape measures, if he used those in the office, you know, staplers, he could write off all that stuff there here. Let's say he has a total, he says he has a total of $1,000 in office supplies. Boom. You type that in there. All right. General rule for self-employment, and you guys want to write this down. It's always good to have at least 4 expenses. At least 3 to 4 expenses. I recommend 4 to 5 expenses. You know, if you have 4 to 5 expenses, then it shows the IRS that you did actually materially participate, and you know, this is a actual well-rounded business. Now, some businesses don't have all this. You know, some have 1 or 2. You know, and that's fine. You know, some people may just have supplies. They sell stuff wholesale. You know, I know a guy, he sells little electronic devices he gets off the internet. He orders a lot of these little cell phone watches from China. He sells them straight out of his house. Or he goes around mobile and sells them, you know, little cell phone watches, different types of little electronic car radios and stuff like that. He doesn't really have to do anything but write off his supplies and his advertisement. He doesn't have anybody that helps him. He doesn't have an office. He doesn't really have too much of anything, you know. Sometimes he doesn't even drive. He lives near a shopping area, and to save gas, he'll just walk over there, you know, because he knows he's gonna be there all day. So he's gonna be walking all day. He say he might as well just walk on over there versus burning the gas. So he walks over there and he sells, you know, whatever merchandise he has. So all he has to write off is his supplies. So, you know, different returns equal different situations. You want to make sure that every return doesn't look the same as well, you know, because if it does, then it could be a hint that, you know, you already have a pre-selected formula in mind and you're giving everybody the pre-selected formula to get them all the same amount. You know, you don't, everyone that comes in, they're not going to be able to get the max. You can't get everybody the maximum refund. You know, we can get them the maximum or as close as we can to get them in an area that they love and they're comfortable with. But, you know, everybody can't get the max. If the max is 8,000, everybody comes in your office isn't going to be able to get 8,000. You know, I don't want to see any of you guys, you know, get in trouble for doing different stuff. And at the end of the day, it's not worth it. You know, do what you got to do, make your clients happy, but, you know, don't go overboard. You know, I've seen prepare letters from different preparers that have received letters from the IRS. Some receive warning letters. Some got to knock on their door. You know, the warning letters usually say, hey, look, you know, it seems that you have a predetermined formula already calculated, and everybody comes in your office, no matter how many dependents, no matter what they have, they get the same amount of money. You know, what's going on? You know, sometimes they'll send you a letter and just ask you or warn you. They'll say this is your warning letter. About earned income credit as well. You know, some people, they you know, no matter who comes in their office, every dependent qualifies to get earned income credit. You know, if the child wasn't under the age of 19, then, you know, they're clicking the button saying that child was in school. If the child was over 24 years old, then they're clicking the button saying that the child is or dependent is permanently or totally disabled. And the IRS has records of this stuff. They're like, hold on now. Now, this person can't be permanently and totally disabled because of the simple fact we have a W-2 here with this person's name on it, and he's not disabled. He's at McDonald's. He's, you know, if he's able to you know, lift the fryer or you know, flip some burgers or use some buns or whatever they're doing, being a cashier, you know, he's not disabled. He can work. So, you know, you want to be careful with that. Everybody, you know, is not going to be able to be disabled. Everybody's not in school. The IRS gets records of that. That's why they issue out Form 1098-T. All online universities and places like that don't issue out the 1098-T, but, you know, 9 times out of 10, the IRS does have record that someone is in school. Okay, so we're going to move along to pension and profit sharing plans. If he doesn't have that, and he's not under a profit sharing plan, he doesn't have a business partner or anything like that, we're going to leave that part blank. All right. Rent or lease. If he rents or leases any equipment, write it in, the amount that he paid for the lease. Let's just say he's a painter, and he had to rent a scaffolding machine, you know, one of those machines that he went up on he had to go up a certain amount of feet on a building, so he had to rent the little thing that lifts him in the air. Let's say it costed him a total of $450 to rent it for that day to get the job complete. He can write that off. If he leases any type of machinery or any type of equipment, anything, you know, put it in. Other business property, anything that he rents or leases, you know, he can put it in here. Even if a taxpayer leased a vehicle for a term of 30 days or more, you know, you can write off that in here. You can write off the office space. You know, we say he has an office space. Let's write it off here. Let's say his office space rents for $300 a month. He had it all year long. We'll type in 300 using our tax-wise calculator times 12. It's $3,600. We'll tab off. Of course, the refund did drop in because, you know, we're writing off, you know, an extensive amount. There's what's called brackets. They're tax brackets. And that's how a refund is calculated. Generally, with the amount of penance that this individual has, the tax bracket is $15,000. And I'll tell you guys this, and you can jot it down. This is very helpful and going to be very helpful to you to help out clients, or just, if a person comes in and they say, hey, look, I just want a quick estimate, you can just tell them verbally if you know these things before you get all the way into it. Jot this down, and we do have some cards that you guys can get today, and it actually has this on it. But if the AGI amount, which is in your refund monitor box, if the AGI amount is, just put 10,000. Now, it's not a whole number, it's just around about 10,000. It can be 9,800, it can be 10,500, 10,700, 10,000 to 11,000 with one dependent. The maximum earned income credit that person will receive would be around about $3,200. Okay, if the AGI is around about 14,000, again, it can be, 13,500, it could be, in the high 12s, but around 14,000. It could be a little more, but once you go over a certain amount, let's say if the roundabout figure is 14,000 and you put in, and there's 16,000 worth of income, then it may drop the refund a little bit. But just to know your earned income credit tables, and this is something that can be downloaded from the IRS. This isn't someone making up. The IRS gives you these books, and that's how we used to actually calculate how much we were going to get back before tax season even hit. We would look at the earned income credit chart in the irs.gov book, or go to the irs.gov website, and we would see the amount of income that we made, and then we could look at that chart, and we'll know pretty much around about how much money we're getting back. Okay, now 2 dependents, around about $14,000. Earned income credit, the maximum earned income credit given will be a little over $5,000. So $5,000 to $5,500 will be what it results to for the year, tax year 2013. 3 dependents, AGI around $15,000, and you guys will see, that since we typed in $3,600, it dropped the AGI in a big way. So I'm gonna take that off just so you can see it. When his AGI was around about almost 15,000, then his refund was at its highest. But 3 dependents, earned income credit, the maximum earned income credit amount for 3 dependents would be around about 6,000, a little over 6,000. 1 dependent, 3,000, or a little over 3,000, actually 3,250. 2 dependents, around about 5,500. 3 dependents, a little over 6,000. And what this is, and what the reason why I'm saying this is, a person might just walk in and say, hey, look, I did hair. I made around about $12,000 this year doing hair. Didn't have another job. The rest of my income came from the state. They give me Section 8, and, they pay for everything else. Plus, I get child support, so that's how I was able to live. So, I have 2 dependents. Do you know what I could probably get back this year? And you can let them know, it'll be close to around the $5,000 range. We'll just have to actually key it in just to see what we can get. Now, I did say how much earned income credit a person can get back. Earned income credit does not calculate into how much of a refund amount that a person can get. I'm going to go ahead and take this $3,600 off just for training sake for right now, and let them get that $8,200 refund up there. Now, earned income credit means how much you'll get back in earned income credit. But remember, a person also has self-employment taxes, and there's other taxes associated with this tax return. Now, to find out how much earned income credit a person will receive, you'll go to the Schedule EIC, which is the Earned Income Credit Worksheet, and you'll scroll to the very bottom where it says Earned Income Credit. And so, since this person is around about that AGI of close to 15,000, he is getting credit for $6,000 of that earned income credit. Now, if he didn't have this W-2 on here where he was also receiving a portion of this federal withholding and some of these other taxes back, he wouldn't be getting a full $6,000. It just calculates, and he would probably be getting, in the upper fives. Once they take their self-employment credit out or self-employment tax out, and they take out that 300 some odd dollars, he'd probably be getting like 5,600 back in hand. So that's the difference between earned income credit. It doesn't mean the exact amount you're going to get in your hand, if you're self-employed. It means the amount that you are, due, but then there are taxes taken out of it. So these figures could actually help your clients to know how much they're going to get back, and it'll help you remember the limitations for, how a person gets a maximum refund. Everybody didn't do a maximum refund, just like I said or stated before. Some people don't make $14,000. Some people make $25,000 on their doing what they do on the side, and they want to report it. So they report their $25,000. That AGI is $33,000. They still get a refund of $2,100 left over. Some people are going to have high income, and you can use a form like this to actually help them write off what they spent. If you made $25,000 and you don't have it in the bank at the end of the year, let's find out where you spent it. We can find out where you spent it, and a lot of it was taxable, or you're due tax money back. Let's find out what you spent it on, and let's put it in. Okay. Repairs and maintenance, I'm going to just give you guys an example, and then we're going to go back to our regular figures. Let's just say repairs and maintenance. This person here actually had to repair some things in their own home or in their business for them to actually operate. They had to add some shelving. They had to paint some walls. They had to put down some carpet. They had to repair the sign outside so it could have their name up there. Let's say all this stuff costs about $7,600. Tab off. Boom. So, everyone isn't going to be in the exact AGI range to get the maximum earned income credit. But, the closer it gets to that, the more of a refund they get. If he spent $9,600 on this, boom, it goes there. If he spent $10,000 on this, it goes there. If he spent $11,000 on this, it goes there. If he spent $12,000 on this, it goes there. So on and so on. And that's actually how, a person that, has high income can write off some things and get that money back. And that's why you hear in the news and things of that nature on the internet, they're making higher tax brackets for the rich or people that make a large amount of money. It's because the reason why the brackets are higher, it means that they're going to tax them more. Because if a person makes, $200,000, I have a friend of mine, I do his taxes, he makes around about, it's over $200,000 a year. Okay, well, and he actually reports it, it's on his statements and everything. But he writes off a lot. See, they give you a higher bracket depending on the amount that you're reporting, because they can tax you more and try to not give you back that money. Our job as tax professionals is to find our clients every penny that's due to them, but like I said, not go overboard. You want to be a great tax professional. You want to get these clients back all this money that they've been missing and that they've spent all year long. I'm going to give you guys just a brief example of something, and it'll just, let you know about taxation and, why it is. Okay, now, the reason for taxation is to actually, pay for government things, sometimes if you work a job or when you work a job, it goes towards, Medicare, Social Security, things of that nature. Okay, now, the taxation for businesses, go back to the Internal Revenue Service or the government. Okay. This is what happens. I'm going to take an example. I'm going to give you two examples about inflation. This is how inflation works, and this is why you see things changing in the world around you. All right, I don't know, if you guys have recently went in the store and bought a bag of potato chips lately, but I'm going to use potato chips. Okay. If you buy a bag of potato chips now, and let's say you're getting the ones, they're 2 for $1. Chips just became 2 for $1. Imagine that. Now, just last year, you could get 3 bags for $1. In prior years, you could get 4 bags for $1. Why is that? Because the taxes and the inflation on the economy, the Frito-Lay has to give you less potato chips now because they're being taxed so much more, but they have to charge more for them. You're getting less chips and you're paying more for them. Back when we were paying a quarter or 25 cents for 4 bags of chips, well, for 1 bag of chips and $1 for 4 bags of chips, you were getting almost more chips than you are now when you're buying the bag that's 50 cents. So I'm using potato chips as that one example of inflation and taxes and putting more charges towards corporate businesses and things of that nature in higher tax brackets. The people that don't really make a lot of money, we're the ones that are actually funding all these bigger companies. And I'm going to give you an example of how. Okay, when you go and buy that brand new pair of Jordans, you've been waiting on those number, whatever they are, and then they finally came out. Okay, you're going and you go to the store and you buy those shoes and you pay your state taxes. You're paying, in Tennessee it's 9.25. Well, that same store that you bought those taxes from, you pay taxes. Okay, now the store, they got to report the taxes on the shoes that they've sold. Not only that, they got to report taxes on the merchandise that they have. When they bought the shoes, they paid taxes on them. Or if they bought them wholesale and they didn't have to pay taxes at the time, they still have to pay taxes on them. So, a business has to pay taxes on stuff that they buy as well as stuff that they sell. Okay. Now, not only that, the shoe store, let's just say it's Finish Line. Not only did they pay taxes on the shoes that you bought, and they paid taxes when they bought the shoes. Okay, now the place that they bought them from, the manufacturer, if it wasn't directly from Nike, that place had to pay taxes on the merchandise sold as well as the merchandise bought. Let's say they bought them directly from Nike. So Nike has to, by Nike selling the shoes to that company that sold them to Finish Line, they got to pay taxes because on the profits that they made. Okay, not only that, they got to pay taxes on the material to buy the shoes. Okay, or buy the material to make the shoe. Not only that, they're paying taxes on all the employees that are helping, make the warehouse function. Not only that, they have to pay taxes on other things just to operate. Just because they're a big corporation, they may be putting out and pumping out pollutants into the atmosphere. So they're paying taxation on that. Okay, not only that, they got to pay taxes on the space that they have, the property taxes. Everything goes back to taxation. So, basically just, tax in a nutshell is basically about just everything results almost back to taxes. So think about that. That's why you're asking your client all these questions about all these expenses, because if you really sit down and calculate how much taxes you pay over a year's time, even at 9.25%, if you make $30,000 and you don't have it at the end of the day, think about at the end of the year, think about how many times that money has been taxed, when you bought stuff. So the government, they take in trillions of dollars and they pay out billions. So tax season will always be around because they take in way more than they pay out. Just think about it. I'm going to give you just one more example and then we're going to get back to the lesson. Okay, Walmart. Let's just think about all of the workers in Walmart. They're due a tax refund. You'll think, oh, that's a lot of workers. But you know what outweighs paying those, paying tax returns to all those workers? The taxes that Walmart, the corporation, has to pay to the government for operating. Walmart may pay to the government so many hundreds of millions of dollars, and all Walmart employees, depending on, their level, might have only, their refund amounts altogether might only total, maybe $100 million, So, taxation is a big thing, and I want you guys to just, look more in depthly into it and think about your own financial spending and things of that nature. This season comes one time a year. It can make or break the rest of your season depending on how you spend your tax money. So we're going to get back into it. I'm not going to go too far off in left field. But we're going to go back with our original figures, okay? The $5,000 that he made. And then we did say that, he did lease his building for $3,600. I'm just showing you how to key in expenses. Let's say he didn't have any repairs or maintenance. And his supplies, let's just say he had $1,100 in supplies. Boom. Now, you don't have to have as many expenses on every return. I'm just showing you how to key them in and fill them out. All right. Now, meals and entertainment. If he did have any meals and entertainment, and a lot of people don't understand what this is, but I want you guys to know about travel, meals, and entertainment. Travel, meals, and entertainment is if he had to travel to do his work and he had to rent a hotel room, guess what? It goes right there in travel. The gas money he spent traveling, it goes in travel. He can also, put short-term car rental leases right here in travel. And meals and entertainment, if he had to go out, and talk to a person to try to get them to let him be their painter, and he had to buy them lunch, let's say he spent $130 over the term of, all year just buying lunch, at different Rafferty's or something for different clients just to convince them to let him be their painter, he can write that off. And you just type in the full amount, the software calculate how much it's going to give him back. If he had any type of utilities, if he had to pay utilities at his office, he can write those utilities off. If a person operates out of their home, you can write a portion of those utilities off. Utilities does not only constitute for lights and electric, but also a phone line. That's utilities as well. So, he can write off his utilities. Let's just say he used $500 worth of utilities. You can write that off. Now, the only, there's nothing else to fill out on this Schedule C form. We've talked about it in depth. But the only other thing that it's asking about is if all investment is at risk or some investment is at risk or is not at risk. You're more than likely going to always want to click all investment is at risk, because if a person, had expenses, then those, this is his livelihood, this is business. So yes, all of his investment is at risk. Because if you select some investment is at risk, sometimes it'll give you a bigger refund, sometimes it won't. So you just have to, but all of John's investment is at risk. Okay. Now, I've showed you guys the Schedule C. The only other thing about the Schedule C we're going to talk about before we go into the Schedule A is when the IRS receives this, it's going to look real funny to them because it has all zeros at the end. 900, 750, 1500, 1000, 3600, 1100. Well, even though these figures could be true, you want to ask your client to give you more of a rounded number because it looks like all this stuff was made up. And the things that are made up is what the IRS look into. The thing about taxes and tax preparation, it has to make sense. If someone gave me this tax return to look at, I would say, yeah, they made this up. There is no specific formula. Just ask your clients to give you round whole numbers. Advertising, if he did get business cards, things of that nature, advertising a magazine, newspaper, whatever he did, pretty sure he had some taxes on there. So ask him, what type of taxes did you have, or what was the full round number? Contract labor, that's understandable. You probably did pay somebody $7. If he wasn't paying them by the hour, if he was just giving them just some money for helping them, $200 here, $250 there, another $300, that's understandable. Insurance, insurance has some type of taxes and stuff due, so just ask them. One of the biggest audits on self-employment forms are all zeros, no expenses, and you guys want to jot this down. The biggest red flags on a self-employment return is all zeros, no expenses, too many expenses. We wouldn't even want to have, this many if he didn't have it, because it has to make sense. There's no way that John could have, if this was true, spent $10,000 in his business and it left him with the AGI of $9,000. This just doesn't make sense. So you mean to tell me what the AGI or adjusted gross income is how much money you actually had to work with after you had written off your expenses. If you didn't actually, if you had only earned $9,000 on the year, there's no way. And remember, John has 3 dependents that he said he'd been taking care of all year. Class, does it sound likely that this man had taken care of 3 dependents off $9,000? And he's head of household? No. So, it just has to make sense, and you want to talk to your clients about it. A lot of people, they think that if they write off a lot of money that they'll get back a bigger refund. Do they have to bring us a copy of their receipts and things that they paid on their self-employment income? No. They can bring us a log of what they have. They can bring us some type of, if they have receipts and things of that nature, they can bring them in. We love to help them with them, but we're not CPAs. We don't get paid to actually add up receipts. We ask that they do this at home and bring us what they have. It would just take too long. I actually had a client one year. He brought me a garbage bag full of receipts, an actual garbage bag full of receipts. I'm like, what is that? I thought he was bringing gifts for the office. He had a garbage bag. Then he said, hold on. And he walked outside the office, and he pulled in another bag. And he thought we were going to sit there and count and calculate all this stuff. No, that just takes too long. Sometimes clients bring in shoe boxes of receipts. No, you just have to tell them, our job, we're not CPAs. Our job is to just prepare your taxes. So, ask them to come to their tax appointment prepared. They'll ask, what should I bring? And write this down. This is very important. When a client asks, what should they bring? Let them know to definitely bring their driver's license or state ID, Social Security card, dependent Social Security card, all working income statements, and anything that they paid for that they'd like to, a notation of anything that they paid for that they'd like to write off on their taxes. Yes, so make yourself a what to bring list and tell your clients to bring those things. All right. Now, so we've talked to John, and we're like, John, the IRS is going to want to look at this. And we're like, a lot of this stuff is just, your AGI is so low, they're not going to believe you took care of 3 children. Then John might confess and say, you know what, that office I was telling you about, it is an office. I share it with somebody. It's a free office. I don't pay anything for that office. Okay. So you take that office expense off. Make sure he signs his name by that, Now, let's just say John say he did have the expenses. Let's say he didn't have any insurance he paid for. He's just a bootleg painter. And he don't really have any insurance he paid for. He's not licensed or bonded. He just tells that to his customers because it sounds good. Take that off of there. And, just review everything with your client. Make sure that they have everything on there, that they did do. And again, you want to make sure that you don't just have a lot of zeros. That's one of the number one audits, all zeros. We're not asking you to make up anything, but ask your clients to give you more of a rounded number. And this right here will look like a well-rounded, Schedule C form. A person actually could receive $5,000 cash. He may have charged $1,000 a job, whatever he did. He would have to bring a report or a log. He can bring that and show it to you, or he could just write it down himself and bring it in. And we could prepare it. I prepare a lot of people's taxes that have CPAs, and their CPA gives me all of that stuff, and then I prepare their taxes from there. So the IRS does not say that a personal individual cannot be their own CPA. He may very well be his own CPA and keep up with his own expenses and receipts. We just want to make sure that he's reporting them. So this is how you actually complete a Schedule C. If you guys have any questions, by any means, and by all means, write them down. We'll get to them. Now, the Schedule C also has a page 2. If you should ever need it. This is where someone that would actually have a store or something where they have some inventory. You can report the inventory that they had at the beginning of the year and the year-end closing inventory, things of that nature, materials and supplies that they had. For your more so home-based businesses and things of that nature, just your regular entrepreneur that just does their own thing after work or just, self-employed at home, you would only need the page 1. If they did have any expenses for their vehicles, this is where you would put it, part 4 of the information on your vehicle section, and they could actually write off, miles, mileage, and things of that nature. The software will calculate, how much mileage they're due back. And I'll just show you an example. It says, when did you place the vehicle in service? Let's say he put it in service, the first day of January in the prior year, 2013. Or it could be 2012, 2011, whenever he put his, he used his vehicle or put it in service, but it just only wants to know how much mileage he used for last year. Okay. Now, if he's put this vehicle in service in 2011, they would also wonder why you hadn't claimed it in last year for 2012 taxes, if that was the case. Okay. So we're going to say John put it, use his vehicle for business last year. Now, to write off mileage, you are required to keep an odometer book or write your own odometer listing, basically saying, okay, at the beginning of the year, how many miles were on your car. If there were 78,000 miles on your car, you would put 78,000 miles in your odometer book or log, or just write it on a piece of paper, and every time you drive to do a business appointment or meeting or anything resulting in business, you'll write down how much mileage it is at the end of the day. And that's why a lot of people don't have that log. That's why I always suggest to people, hey, if you don't have your records typed about your mileage, don't do it. Now, truck drivers, they always have their mileage typed because they're required to keep it. I know someone that works for the state. She's a field rep. She goes out and goes different places. She's required to keep her mileage. So, if that person doesn't have a log, you want to just say, hey, look, you might not want to do this because they might ask to see it. They know that a lot of people don't have it. So that's why it's one of the other highest ranked audits, the mileage, because they know people don't have it. So let's just say, over the course of a year, John said he put 6,000 miles on his car. It's for business, commuting other places, because the IRS knows if you have a vehicle and you're driving around all day, you have not just driven only for business purposes. You went somewhere else out to business and things of that nature 9 times out of 10. So let's just say he had commuting. He didn't have any other. And it says check here to calculate business miles at the standard rate of 56.5 cents. So, boom, we calculated it. And it actually took away from his refund. So, in some cases, this does not help you. And it says, was your vehicle available for personal use or after off-duty hours? If he says yes, then they know that, no, you probably drove it somewhere else. If no, it was not available during off-duty hours. He had another car. It says, then it asks, do you or your spouse have another vehicle for personal use? If he selects no and he says that he didn't use his vehicle for personal or off-duty hours, then they're like, okay, well, how did you make your personal runs? How did you go to the store? How did you get groceries for your own personal self? If you didn't have another vehicle, but you didn't use this vehicle. So, yes, he had another vehicle. And do you have evidence to support your deduction? Yes, because if no, they'll be like, oh, okay, well, we need to audit this person because he don't have no evidence. He just stated this. Well, that's a definite audit because this isn't supposed to be, made up. It's supposed to be an actual figure. Okay, and it says if yes, is this written? Yes or no? Yes, he does have it written out. That doesn't X him out of getting it if he was due the deduction. Just because it's written, it's supposed to be written. Or it can be typed up, it's fine. All right, other expenses. You could go here if a person has other expenses, type in things like internet, calculate how much of his internet bill may have been, $76 a month. He may have had that 5 months, $380. But you want to ask him, well, what are the taxes, fees, and all this stuff on there, you don't just want to put in 380. He may have had, any other expense that you did not put on the first page. You can put it here. Let's just say he had to get a haircut. He had to look a certain way. A lot of people don't know that you can actually write off haircuts. If you have to look a certain way for your presentation, you can write that off. If he had to buy a certain type of outfit or suit, if he had to buy a suit, and this is for business, he got to look good, don't he, to go out and gain business. He can write that suit off. He can go in and write this stuff off. Again, you want to watch your AGI, but I'm just giving you guys some examples. So, all of that stuff, anything that you weren't able to list on page 1, you can put it on page 2. All right. Now, if a person has a W-2 and their AGI just doesn't reach the maximum, you can ask them if they did anything on the side, and they can add income from, self-employment, or if they have a 1099, they could add income, but everybody just isn't going to reach the maximum AGI. You know, some people going to come in with a W-2, they've already made 40-some thousand, and they, you know, they may not be due a lot back. You know, that's just the fact of it. You know, if they didn't do anything on the side, they just didn't do anything on the side. A lot of people do. You know, I know a lady, she makes about, like I said, 42,000. She does baskets. She makes baskets and stuff like that, so she gets to write off all of the expenses for the baskets she makes. And, you know, she doesn't really make a lot of income off the baskets. She just like to do it, you know. So it could be considered hobby income, and that's something that you don't, you know, you don't want to put that a person has a hobby, because, you know, that hobby income, that it's not really a hobby. It's just something you like to do. But this is actually a business. It just hadn't taken off because she works a job full time and she just hadn't had the time to put in it. But she's still allowed to be able to write off those expenses from this business that she is creating, because who knows, one day it might blossom and turn into something really big, and she's able to let that job go. And so, you know, in the case of a person like John here, you know, I have a lot of clients like John. You know, they work a job, they work for someone else, but they're doing a business, and they make a little money, but, you know, their other job is really where they're getting the money to pay for this business. You know, you might know people that actually work a full-time job somewhere, and then they might throw parties on the side or something. They might put in $2,000 or $3,000 just getting rent out of space, getting some flyers, different stuff like that, and they might not actually even really turn a profit on the party. That's fine. This is where you report it. It's called the business profit or loss form. Every business does not profit. Some have losses. Every business has losses. You know, it just depends on how much profit you made outweighs your losses. So, you know, you just want to ask your client, you know, if you had anything that you invested in. You know, an investment constitutes for a reason to actually write off. You know, a person may have some investments. So, you know, you just want to talk to your client and see exactly what they have, and then go ahead and fill out their return. All right. So, you know, and if that person's AGI drops, you just want to verify with them. You're like, okay, John, now see, I know what your AGI is. Now, there's something on here you're telling me about that you just didn't do, you know, because of the simple fact, you know, you couldn't take care of 3 children with this low of an AGI. You know, if he doesn't have a logbook of the stuff that he's reporting for his car and truck, don't put that in for him. You know, I just want to show you guys how to do it. Because you don't want John to be on, you know, him mad at you. Okay. All right. Now, one of the last things we're going to take a look at is this Schedule A. So, we talked about the Schedule C. Let's just say John says he did invest a little money. You know, he had a little investment. Wasn't much. You know, had a little investment. You know, so we're going to go in and type in Schedule H, which is SCH space A. Click on it, and let's take a look at this Schedule A here. Let's take a look at it. The Schedule A is about medical and dental expenses at the very top. But before we get into it, as with any other schedule or form, we're going to start from the top. So U.S. Schedule A talks about itemized deductions. It's for this tax year. It's for John Smith. And if the spouse has some Schedule A's to write off, you know, you write off their schedule, you know, you just open up an additional Schedule A and just put it on there for the spouse. All right. The first portion talks about medical and dental expenses. Now, mind you, I'm going to show you an example of the Schedule A and how this works. Now, to even get any money on the Schedule A, now, with us knowing and being tax professionals, we know that John's not going to even get any money on this Schedule A, period. No matter what he puts, he's not going to get any money back. Why? Because he has to beat what's called the standard deduction. Write that down, you guys. Standard deduction. What the standard deduction is, it's a amount of income already preset, or amount of money already preset that you have to exceed before you get a dime back. And you have to already be in a certain bracket. So since John is already really under the bracket that he can get anything from the Schedule A, he could put in all his Schedule A items, but it's not going to get him any more money. Schedule A only gets you money if you make over a certain amount of money. Okay, so John didn't make a lot of money, so putting this stuff in would be really just obsolete. But if he wanted to report it, and he has to report it, then let's put it in. I'm going to explain this to you. All right. I'm going to explain it briefly, and then I'm going to do another training with Schedule A more in depth. If John wanted to write off unreimbursed medical and dental expenses, what this is also not just, talking about if he had to do a copay, he had to go to the doctor, he broke his arm, he fell off one of his paint ladders, and he had to go to the hospital, something like that. No, that covers that and more. This also covers medical and dental means if he got a little small cut and he had to get Neosporin, and then Neosporin was $3-4, he can write that off. His dental hygiene, he has to buy toothpaste and a toothbrush for every time he has to brush his teeth. That's a dental expense. He has to buy floss. He has to keep his teeth clean. This has nothing to do with business. This is for every individual, period. You all are entitled to medical and dental expenses, whether you are self-employed or not. This doesn't have anything to do with business. Your deodorant that you have to buy, this is a medical expense, because you have to keep your hygiene where it needs to be. Females, they have female products they have to buy. This is a medical expense. How do I know that all these things are medical expenses? Because I looked it up. I was actually watching one tax, it was a late night talk show, but they had a tax expert on there, and her name was the tax lady, and she talked about just all types of expenses, and she showed where you can find it in the tax code. But the thing is, people don't know it. So if you don't know it, you can't put it on here, because you just don't know it, So knowledge is power. That's why I say, don't let your training stop here. Expand your knowledge, go further. Okay, but like I was saying, medical expenses goes for, and this is for you and your dependents. If you paid for anything, for your children, diapers, all children always have little scratches, bruises, band-aids, all that type of stuff. This is where you write this stuff off. Medical and dental expenses. Not to spend too much time on it, we're going to go on down. State and local taxes. If you had state and local taxes from the prior year, you had to pay state taxes back, which was like income taxes and things of that nature. If you had a state income tax that you had to pay, write that stuff off. There it is right there. All right. Real estate taxes on your principal residence. If it's not listed above, put it in. If you got a form, anything with any of this stuff here, you're going to have a form. So you don't have to worry about trying to calculate it out of your head or anything like that. If a person comes in with a form 8829, this is where you're going to type the stuff from that form right here. It's not going to let you type it here, so just look for where you can type it. It's going to be right here. Okay. All right, so we're going to scroll on down. Personal property tax, if it's not listed above, boom, there. Home mortgage interest, very important for homeowners. Everybody that's a homeowner or future homeowners, we hope that each one of you guys all get a chance to experience home ownership. It's a beautiful thing. It's a wonderful thing. And if you need help with that, that's another service that we offer, not just wholly to the public. It's not something that we're just broadcasting. But if you guys need any help trying to, become homeowners or get that next step going in life, just let us know. We'll get you pointed in the right direction. I myself, I can help you guys with your credit, show you guys how to line up your expenses, your accounts, all that type of stuff. So, but this is where, if you're a homeowner, you would put in what's on the form 8829. If a person hands you a form 1098 for a home mortgage interest, it goes here. You would just type in the things that are on that 1098 form, and we have some in the office that we can show you. I don't have one I can pull up right now, but it'll just ask for the information, the individual's name, ID number, all the stuff will be outlined on the form. You'll type it in, and where it says T, S, and J, write this down. On Schedule A, where it says T, S, and J, what that is, it just wants you to select T for taxpayer, S for spouse, or J for jointly. If it's just the taxpayer's mortgage interest, and that's the only person on there, boom. If he has a spouse, put in spouse. If it's the spouses. If it's their property together, put in J for joint. That's all. So anything in this section, interest you paid or taxes you paid will be accompanied by a form. All right. We get this question a lot. A lot of people say, hey, look, I want to write off my tithes and offerings. I paid tithes to my church. This is where you write off your church tithes and offerings right here. It says it's under gifts to charity box. Gifts to charity, church tithes and offerings. Gifts to charity, church tithes and offerings. And you can write off how much a person put in their collection plate or wrote to the check to the church. And then it says if gift other than by cash or check. This is if you gave something to a charity or like the Goodwill. You know, if you gave the Goodwill, you know, something of some value, they usually give you a tax deductible receipt. Some people give cars away. Some people give boats away. Some people give furniture away. You know, if you give away a old furniture set, you just went and got you a new furniture set, you're giving away the old one. Let's just say it wasn't old for the purpose of it was worn out and raggedy. You just, you know, you just wanted something new, and you gave it to them. They probably giving you a tax deductible receipt. They might say, okay, this piece of furniture is valued at $125 for this couch and love seat. You know, so you know, you can put that on your taxes. You can carry over from a prior year as well. You know, if your taxes, if you couldn't deduct it in an earlier year because they exceeded the adjusted gross income limit, you know, you can put it in there. You know, a lot of people give away a lot of stuff. So, you know, you can carry over from a prior year. Or let's just say you didn't put it on there, you know, from a prior year. Let's just say you got $100 of items you just forgot to put on there from 2010. Boom, as long as you got their receipt, because it's a charity, they'll allow you that deduction again. And as you see, you know, it's not doing anything for the refund because he doesn't reach the standard deduction amount. You know, even if you type in 15,000 and some odd dollars, he just doesn't have the income for the Schedule A to do anything for him. But I'll show you, you know, in another lesson, you know, more in depth what could change it. But right now, really, honestly, you know, if you're a starter preparer, you'll be preparing just basic returns. You won't get into too much in-depth stuff. We have people for that. And we want you just to start here. But then, like I say, expand your knowledge. Get where you want to be. Become a great tax professional. Let's move on up in the ranks. Let's become one of those people that, you know, one of your you know, colleagues can call and say, hey, look, I had a question about this, and you can answer that question with confidence. We need people like that. We're looking to grow with everyone. All right. Moving along. Schedule A still, casualty and theft losses. Casualty and theft losses. What is this? This is in the case, you know, someone had something stolen from them. They had a casualty loss. Let's say their house burned on fire. You know, that's a loss. Let's say their house got broken into. They taken all the electronics and things like that around Christmas. That's a casualty or a theft loss. Let's say their car got stolen. All this stuff, you probably didn't even know. You can write this stuff off. Casualty or theft loss. Let's just say John he was unfortunate to have a vehicle taken. It was valued at around about $2,000. You know, he has a police report on it. Boom. You write off his casualty and theft loss. And then if you have more than one, you can go to where it says, it tells you right here, attached form 4684. Let's say it's just been a bad year. You can just open up a scratch pad and you can write off what property and how much it was and things of that nature, you know, and add more to it. So we're going to go back to our Schedule A because that's what we were on. And it's very simple, you guys, to find any form. Just look for it to the left side in your forms tree. And I hope I'm not, you know, giving you guys too much at one time. And I hope that this is not confusing to you guys. If it is, please write it down and we'll get to it. All right. Last but not least, we're at the very bottom of the form, and I'm going to talk to you guys about a couple of different things that are very important. Unreimbursed employee expenses. This is if you work a job and you have unreimbursed employee expenses, meaning that you had to do job travel. You know, the gas that you had to put in your car to drive to this tax training course, this is an unreimbursed employee expense because you got to make it to work. Okay, if you have to buy a certain, let's say you work at FedEx. I worked at FedEx years ago, and I had to purchase work boots, our steel toes. That was before they were giving them to us. We had to purchase it. Whether it comes out of your check or not, it's an unreimbursed employee expense. Job education. If you're paying for a tax training course, you write off that because it's an unreimbursed employee expense. And if you're in the right tax bracket, you know, you can actually receive some of this money back. You know, let's just say John, he works for that other company. He works for Kroger, and he had to buy, let's say he's a forklift driver. He had to buy some gloves He had to buy some boots because it was cold. He had to buy some goggles because sometimes he had to drive his forklift outside the warehouse or something and it's cold and rainy. Let's say all that stuff totaled to an amount of $312. You know, you can write off unreimbursed employee expenses. Tax preparation fees. If he wants to write off his tax preparation fees from a prior year, this is for him. He's John. He's a taxpayer. Let's say, you know, that $4.99 he paid to have his taxes did last year. He writes that off. Now, he already written it off on the Schedule C, so he can't write off twice. But if he did, you know, if he wasn't self-employed, you know, for any individual period, you can write off those prior year tax preparation fees. Office expense, investment expense. Again, this is for people that are not self-employed. You know, if he had any type of expense, investment expense, let's just say he invested $2,000 into something, whether it paid out or not, boom, you know, he'd write off that investment, and it's for the taxpayer. And he wrote off $2,000, and you have to list the type of investment. We'll just say investment. He invested in a car to try to sell. He still has that car. You know, he can write that off. So there's all types of things that if you use your tax preparation skills, you can write off for a client. Also, some things that are in here that we hadn't went over. You know, if a person has gambling losses, they can write that off. You know, a lot of people that come from Mississippi or Arkansas, you know, you got the Southland Greyhound Park, you got the casinos down in Tunica. You know, a lot of people gamble now. You know, if they have gambling losses, you know, put it in for them. You know, if they have gambling winnings, they'll be accompanied with a 1099 form that shows it's a 1099 miscellaneous form. And I believe it will show gambling on it if it was for gambling. It's one of those 1099 forms. And they'll actually receive a 1099 for gambling, and you can put that in there. So this is a brief overview, and this is about, you know, our tax software, and it's giving you a lot of great tax knowledge. This will conclude this portion of this training. We hope that all of this will take you to the endeavors that you want to go to in the tax preparation industry. We thank you for attending our course. We hope that it's helpful. And if there's any suggestions, or if you have anything that you may want to add to say, hey, look, this course could be a little better if you add this or take away this, by all means, tell us. We're always open ears. Good luck during the tax preparation industry. Again, remember, you know, your forms tree shows all of your forms that you have. So long as you have all check marks, you know, before we get done, make sure you have all check marks. And if you don't, you know, I'm going to show you just in case you don't have all check marks. Or hold on, I'm not going to. And always remember as well, if you have a refund amount and that refund goes down for any reason, and that person has dependents, it may be because you've incorrectly answered something on the Earned Income Credit Worksheet. So remember, Earned Income Credit Worksheet, you may have entered something wrong. So if you hit no on this, you know, because the answer should be yes for him to get Earned Income Credit. You see, it took away that refund amount. So jot this down, guys. If the income ever goes down, check Earned Income Credit Worksheet. Earned Income Credit Worksheet. Now, I'm going to purposely leave a question unanswered, and I'm going to select Diagnostics. And Diagnostics is what you always select once you've completed a tax return. And it'll tell you if you have anything that needs to be filled out or completed. And it says right here, the diagnostic error is either the business code or the principal business activity must be filled in on Schedule C. Okay. So you click on it, it automatically takes you to the form. Now you can actually finish this right here, or you can close this out and redo it. This would have been where we put in that 1099. It wanted to know what was the principal business profession. The principal business profession that he had for the other company, we'll just say it was salesman. Business code, we don't know it exactly. We're going to hit Diagnostics. And it tells you that there are no diagnostic errors detected. This tax return is ready for e-file. But remember, still have an exclamation point, exclamation mark. Always make sure all your exclamation marks are turned to check marks. That was on that earned income credit page. We're going to tab off. We're going to run our diagnostics again just to make sure there are no diagnostic errors. Here are the forms to be filed electronically to the IRS. U.S. income, page 1 of the 1040, page 2 of the 1040. His profit and loss statement as a salesman. Earned income credit. His self-employment credit, or self-employment tax, because he has self-employment taxes. He filled out a Schedule C form. His W-2. Child and dependent care expenses. Child tax credit, pages 1 and 2. Information to claim disallowed earned income credit. His e-file signature authorization page. And his Schedule C, page 1 and 2. Shows his AGI, total tax, total withheld tax, and his refund amount. He doesn't have a routing and account number that he wants it to go to, but if he did, that's where it will be. And it says that the return is eligible for IRS e-file creation. Then it's going to have just different little warnings and things like that that it may just want you to look into. It says that warnings do not disqualify a return from electronic filing, because if this is what he had, this is what he had. Overridden entries do not qualify a return from electronic filing. And it just shows you things that are estimated on here, which, you know, we didn't estimate anything or do any overridden entries. It was pre-calculated. All right. So, you know, in the case that this return was complete and we had nothing else to do, this e-file button would be lit up. We would click on it and it will be sent to the e-file center, which from then we'll hit communications, send federal and state return, and it will be sent off. Thank you, and great success in the tax preparation industry.